March 22nd, 2018. Charles Lazarus dies at his home, age 94. He is the man who invented the toy superstore, who built a company that once owned Christmas morning in millions of American households. He does not live to see what comes next. One day later, on March 23rd, the company he founded 7 decades earlier begins liquidating every one of its American stores. 735 locations, 33,000 jobs, gone. The founder outlived his empire by exactly 1 day. To understand how that happens, how the company that invented an entire category of retail ends up being sold for parts, you have to go back to a single deal, signed in 2005, that handed Toys R Us the bill for its own execution. In 1948, a young man named Charles Lazarus opened a children's furniture shop in Washington, D.C. called Children's Bargain Town. Customers kept asking for toys. Lazarus listened. By 1957, he had opened something new in Rockville, Maryland, a store that sold nothing but toys, stacked floor to ceiling, at prices lower than the department stores could manage. He called it Toys R Us. The idea was simple, and it was radical. Instead of a toy aisle buried inside a department store, build an entire warehouse devoted to nothing else. Buy in volume, pass the savings down, stock everything, all year round, not just at Christmas. It was one of the first true category killers, a phrase retail analysts would later use to describe exactly this kind of store, one so dominant in its niche it could kill off smaller specialty competitors simply by existing. And it worked. Through the 1970s and 80s, Toys R Us expanded across the country, then internationally, planting its Geoffrey the Giraffe mascot in strip malls and suburban corridors from coast to coast. Parents did not think of it as one option among several. It was where you went. For more than a decade, Toys R Us was not just the largest toy retailer in the United States. It defined what a toy retailer was supposed to look like. Competitors tried to copy the format and mostly failed. The company's buying power let it negotiate prices no independent toy store could match, and its sheer footprint meant it had something rivals didn't. Selection. Aisles of it. A kid could walk in wanting one thing and leave the store having seen everything. That was the magic, and for a while, nobody could touch it. By the mid-1990s, Toys R Us controlled a market share north of 18%, an enormous number in a fragmented industry selling everything from action figures to bicycles to board games. It had scale, brand recognition, prime real estate, and 3 decades of momentum. It looked, from the outside, unassailable. But the same big-box discount chains that Toys R Us had helped normalize as a retail concept were about to turn that concept against it. Walmart, Kmart, and Target had spent years building supercenters that sold groceries, clothing, electronics, and, increasingly, toys. And they were about to figure out something that would quietly reshape the entire industry. Toys didn't need to make money on their own. The first real warning came in 1998, and it had nothing to do with the internet. That year, according to NPD Group's tracking data, Walmart overtook Toys R Us as the largest toy retailer in the United States, taking 17.4% of the market to Toys R Us's 16.8%. A year earlier, Toys R Us had held 18.3%. The decline was not sudden. It was a slow bleed, and it came from a source Toys R Us had helped create, the big-box discount format itself. Walmart, Kmart, and Target did not need toys to be profitable. They used them as loss leaders, stocking the season's must-have items at razor-thin margins or even at a loss to pull families through the door during the holidays, where they'd also buy groceries, clothes, electronics, and everything else under one roof. Toys R Us could not compete with that model because toys were the entire business. It had no grocery aisle subsidizing the discount. This was the crack nobody wanted to name out loud. Toys R Us was still enormous, still profitable, still the brand every kid recognized. But it was losing ground years before anyone was worried about Amazon, years before e-commerce was a boardroom priority. The company's response was largely to keep doing what had always worked: open more stores, lean on the brand, wait for the discounters to overextend. They didn't overextend. And in the background, the company's own real estate and balance sheet were starting to look attractive to a different kind of buyer. Not a competitor, but financial engineers who saw a company with valuable stores, a recognizable name, and steady if declining cash flow. That combination is exactly what a leveraged buyout is built for. In March 2005, an investment group made up of KKR, Bain Capital, and the real estate firm Vornado Realty Trust agreed to acquire Toys R Us for $26.75 a share, a deal worth about $6.6 billion. The buyers put up roughly $1.3 billion of their own money. The rest, more than 80% of the purchase price, was borrowed, and more than $5.3 billion of that borrowed money was not the buyer's debt. It was placed directly onto Toys R Us itself. Before the deal, the company's balance sheet was roughly 30% debt and 70% equity, a fairly conventional structure for a retailer its size. After the deal closed in July 2005, that ratio flipped to roughly 78% debt and 22% equity. The company that had spent 50 years building stores now existed, financially, mostly to carry a loan it never asked for. Debt itself doesn't kill a retailer. Plenty of leveraged companies carry heavy debt loads and survive for decades. What kills a retailer is what the debt takes away from it. And for Toys R Us, that price tag was roughly $400 million a year, every year, just to service the interest on the buyout. $400 million that did not go into renovating tired stores, did not go into building a modern e-commerce operation while Amazon was quietly becoming the default place Americans bought things online, did not go into training staff, refreshing store layouts, or matching the prices the discounters were still undercutting them on. Instead, it went to bondholders. Year after year, the company posted revenue in the billions, a business that was, by any operational measure, still a going concern. And yet none of that scale translated into the reinvestment a retailer competing against Walmart and Amazon simultaneously actually needed. Toys R Us did not report an annual profit after 2013. Revenue slid to about $11.5 billion by fiscal 2016. As of January 2017, the company still operated 961 stores across the U.S., Canada, Puerto Rico, and Guam, a footprint most retailers would envy, and one that was becoming increasingly expensive to maintain on a shrinking margin. On September 18, 2017, Toys R Us filed for Chapter 11 bankruptcy protection, carrying about $5 billion in long-term debt. This was not necessarily meant to be the end. Chapter 11 is designed for restructuring, not liquidation, a chance to renegotiate with creditors and keep the stores open while trimming the debt load down to something the underlying business could actually carry. For a few months, that was the plan. Then came the holidays. The 2017 season, the one quarter of the year that had always kept Toys R Us alive, came in about $250 million below budget. It was a bad number, but not by itself a fatal one. What made it fatal was the fine print. The financing that kept Toys R Us operating during bankruptcy came with covenants, conditions the company had to meet to keep its lenders' support. The holiday miss breached those covenants. With its bankruptcy lenders no longer willing to back a reorganization, the company's options collapsed to one. In March 2018, Toys R Us announced it would close or sell its entire remaining U.S. footprint, about 735 stores. Roughly 33,000 employees lost their jobs. The liquidation sales began on March 23rd. Charles Lazarus had died the day before. By June 2018, Every Toys R Us store in the United States had closed. 33,000 people who had spent careers, in some cases decades, working under that giraffe mascot were suddenly out of work, many with severance packages that employees and advocacy groups criticized as inadequate given the private equity firms involved had extracted management fees during the years leading up to the bankruptcy. KKR and Bain Capital, the firms behind the 2005 buyout, moved on largely unscathed, their exposure limited to the equity they'd put in, while the debt had sat on the company's own books all along. That asymmetry is, to a lot of people who watch this story unfold, the real lesson of Toys R Us. In a leveraged buyout, the buyer's downside is capped, but the target company's is not. The brand itself did not entirely die. It's been revived since in smaller formats, shop-in-shop partnerships and licensing deals, a name without the empire that built it. And it's worth saying plainly, the debt was not the only villain here. Toys R Us was already losing shelf space to Walmart back in 1998, 7 years before KKR and Bain ever showed up, in a shift driven by discount retailers' loss leader pricing that had nothing to do with leverage. Some analysts argue that retail disruption alone, discounters first, Amazon later, would have eventually caught up with Toys R Us regardless of who owned it or how. That argument deserves to be taken seriously. But it doesn't explain away the math. A company already fighting for its life against bigger, better capitalized rivals was handed a $400 million annual bill it hadn't chosen and couldn't easily pay at the exact moment it needed every available dollar to rebuild its stores and catch up online. The debt didn't create the problem. It took away the company's ability to fix it. Charles Lazarus built something that outlasted trends, competitors, and 2 generations of children. He did not build it to survive a balance sheet designed by people who never had to run a single store. He died on March 22, 2018. Not knowing, perhaps, that he'd already seen the end, just one day before the rest of the world did.